Hey everybody, happy Wednesday. My name is Brent Morse. Time for managing an options portfolio. Today's session, I actually want to go over something that was mentioned in one of our surveys. I don't know if we're going to have a survey or not for this class, but just realize when we do have surveys and you give us feedback, we read it. Ben reads it, I read it. Ben, I mentioned Ben because he's alongside in the chat with me. He's been a longtime friend and colleague, and a lot of you know him as he's kind of the face of Schwab's live workshops as well. So he's very knowledgeable in everything I'm going to go through today. So as you have questions, feel free to type those into the chat, and between Ben and myself, we'll do our best to answer those questions. So today, what I want to talk about is I want to talk about probabilities and butterfly spreads. And also, of course, this is managing an options portfolio. So each week in this class, we try to manage a variety of different types of trades just to give you guys a sense for managing trades. So we're going to do that in just a minute. You can follow Ben or myself on X at Brentmore CS, at Ben Watson CS. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation or endorsement of any security, strategy, or chart pattern. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money. The software application we're going to use here is for educational purposes only. I may not factor in commissions into each of these trades, but just realize commissions are a real thing that you do need to consider. All investing involves risk, including risk of loss. And past performance of any security or strategy does not guarantee future results or success. Probability analysis results shown do not reflect any degree of certainty of an event occurring. All right, and of course, we'll go through different stocks, different trades. These are all just examples. They are not recommendations. Let's head on over to the Thinkorswim platform. This is the S&P 500. And just keeps on chugging, keeps trucking along there. Probably, potentially some resistance up here in this range there. And it doesn't mean it can't turn around before that point, but right now the trend has been pretty strong on that. For your reference, this is a 20-day moving average. This is a 50-day moving average. Now, as you're doing individual trades, what I want you to realize is some trades, it's easy to kind of change the probabilities on those trades, okay? Let's consider this for a sec. I'm going to pull up GE, again, just an example stock. GE's gone up, kind of had a pullback. Looks like we're bouncing kind of right off that 20-day moving average. If we were looking for a bullish trade and we decided, hey, I want to do a short put vertical. That's a pretty popular type trade. And we could choose different strike prices. And the strike prices that we choose are going to determine the probabilities of the trade. If I choose, say, to sell a put down here, and I choose to buy a put down here, we'd consider that to be a higher probability trade because my break-even point is going to be down here somewhere, okay, somewhere in that range, okay? In other words, if the stock goes up, that's great. If it goes sideways, it's great. If it goes down a little bit, we're probably still okay. And so that'd be a higher probability scenario. Now let's consider a different scenario. Let's say I did that same short put vertical, but my short put was right here and my long put was right here. Where's my break-even? My break-even is probably going to be pretty close to where we're at. That's not quite as high probability of a trade anymore, is it? The strikes you choose determine the probability. Now, you may go, well, why don't we always just want a high probability trade? Well, maybe you do, maybe you don't, but there's always a consequence. There's no free lunches out there. You can't get high probabilities without impacting other aspects of the trade. Namely, in this case, your reward to risk ratio gets worse as your probabilities get higher. Okay, so that's an easy way to do that in terms of, say, a short put vertical. Same thing, let's say we were sticking with the bullish theme, we were doing a long call vertical. The strikes you choose are going to determine your probabilities. There's some trades, though, let's just, that really, there's just kind of inherently higher probability or lower probability. Let me just to give you a different example. I don't want to get hung up on a particular stock here. Here's Meta, stock you all know, it's been trending up. Let's say we did a long call on this. It doesn't matter what strike I choose. It's just doing a simple long call, or long put for that matter, is a lower probability trade. Okay? Why? Because your time decay, your theta, is working against you on that trade, no matter what. So if I do a long call on Meta, doesn't matter what strike I choose, if the stock just kind of goes sideways, everything else being equal, that negative theta is going to turn this in, it's going to make it a loser of a trade. Okay. Or if I do a long call, if the stock goes down, it's not going to do well on that trade. Now, if it goes up enough, potentially, maybe we make great returns on that potentially. But the point is, long calls, long puts are lower probability trades for that reason. All right? I'm hoping that is making sense there. But now I mentioned butterfly spreads when we were kicking it off here. And the reason I mentioned butterfly spreads is somebody in the feedback said, you haven't talked about butterflies in this class much lately, so let's talk about butterflies. And I'm going to kind of, I'm not going to, I can't devote the whole session to butterflies because I want to get to portfolio management. But let me just mention this. I covered butterflies. Recently, I did a full session in butterflies in my advanced options class. That's on Fridays. I'm going to put the playlist in the chat for you if you are interested to that advanced options webcast. That occurs at 2 o'clock Eastern time on Fridays, by the way. You can look through that playlist. I have them numbered. You can see the different strategies. Easy enough. If you are watching on a recording, you can also just do this. You can go to your YouTube, go to Trader Talk Schwab on the YouTube channel. Just type that in if you haven't subscribed already, if you don't know how to do it. This little demonstration right here is mostly for people who aren't as familiar with YouTube maybe, or our channel. And you'll see something that says Trader Talks Schwab Coaching Webcasts. Well, you click on that, and when you pull that up, it's going to come up here, and it'll give you the choice to subscribe to the channel if you want. But you can also go to playlists. And there's a variety of playlists on here. And for example, market movers. Hey, look, there's Ben Watson right there. He does that each Friday when he's in town. He travels to workshops a fair amount. And so, but he teaches immediately preceding this class is trading index options. And that's a class Ben teaches as well. So make sure you check those out. My point being, if you go here and go to Advanced Options Strategies, you can get that same playlist that I put in the link if you're watching live. If you're watching recording, you don't have access to that link, so you can go right here. Click on the full playlist right there, and you can see, hey, look, we're looking for butterflies. Oh, number 3 in the series was butterfly spreads. Okay, so let's go back. So let's take an example of a butterfly. What is a butterfly? A butterfly is more of a neutral type strategy. You can do call butterflies. You can do put butterflies. Okay. A call butterfly is essentially a long call vertical, okay, where you buy a call and then you sell a call. And a short call vertical, you do them together and you do the middle strike the same, where you buy a call at a higher strike and you sell a call at the middle strike. So essentially you have two calls at that middle strike. Long call, higher strike, 2 calls, middle strike, long call, lower strike. This trade is bullish. This trade is bearish. And so ultimately it's a net neutral trade where our goal is basically where the middle strikes are. That's a butterfly spread. Okay, you can do the same thing. You can do the same thing with puts. Long put vertical, short put vertical, Again, wherever your middle strike is, where you have two puts in that case, that's where the target is going to be. Okay. So Harry asked a question in the chat. Harry said, is the profitability adequate to offset the greater loss of the trade that goes against us? That's absolutely that's the $64,000 question, folks. Okay. That's the key. That's a judgment you need to make. When you're doing trades, whether we're talking about butterflies or whatever else you're talking about, is the probability enough to make up for the potential reward and the potential risk here on this trade? Let's take a look at an example here, okay? Because I want to tell you this. One reason I don't often demonstrate butterflies as much as other trades is that butterflies tend to be lower probability trades, okay? Here's CRM, and what I'm going to say here is this. I'm going to say we're going to be kind of neutral on this. Here's the theory on this, okay? Here's the theory on this. My theory is we kind of maybe have some support in this range, and we have maybe some resistance. Oh, sorry, my line's a little crooked, but basically some resistance there. We've kind of not really trending either way. Our moving averages are kind of going more or less sideways. We're above one, below the other, more or less sideways. Okay? So there we go. So this is going to be more of a neutral trade, and we may think butterfly, okay? Butterfly spread. But let's just kind of look at this as it is, and I'm going to say my strike is going to be about 270, close to where we're at. We're at 268 right now. Okay, so I'm going to go to let's go to my Analyze tab here on this. I've got CRM. I'm going to go to Add Simulated Trades. We'll go to July 3rd on this trade. And I'm going to just do a call butterfly, slightly out of the money on my middle strikes. And I'm going to just do a 265. And I'm going to click on the ask price. 270. I can click on the bid price twice because I want two of those contracts. 275. Okay. So that's a butterfly spread right there. That's a butterfly spread. Let's look at the risk profile, see what it says. Let me just make sure I got my date right. And what I'm going to do is I'm going to set my slices to break even. And there we go. Okay. As I constructed this trade, what's my probability on this? Well, this is today's, let me go, I guess this should technically say the 11th. I don't know that it makes a difference here. But if you look at this trade as I constructed it, it's giving me about a 16% chance of being in between my break-evens. In other words, that's not a good probability. Now, we can tweak it a little bit, and we're going to in just a sec. But this is a very low probability trade. Okay, very low probability trade. But why would anybody ever do this trade? Well, look at how big the probability is compared to the potential loss. Here's your break-even. Clearly more distance between there and there than there and there. That's why some people will sometimes do lower probability trades. But my point is, if you do a butterfly spread, and you're going to probably end up with a lower probability trade. Now, let me spread the wings out on that butterfly just a little bit. Instead of 265, let's go down to 260, and we'll make this 280, and let's see what happens to our probability. Set slices to break even at expiration. Oh, that's a little better, 25, 26% probability on that. So spreading them out wider tends to help that situation. Let me go down to, say, 255, 285. And we're going to set our slices to break even. And we're up to 36%. You get diminishing returns, though, on this. Notice, as we get the higher probability, the difference between our break-even point and our max gain, which we're going to call, for our purposes here, our reward, and the difference between our break-even and our max loss, it just kind of shifted on me there, what we're going to call our risk, that becomes closer to one another. Okay? That's roughly equidistant. One challenge with butterfly spreads is when we talk about a max gain right there, what are the odds that the stock hits right there? Okay, that we do right there on that. So so as you spread them out, the probabilities become better, but typically they're not going to be good. Typically, it's going to be a lower probability trade. All right. Now, I'm going to do a little tweak to this because I want to show you something here on this that where we actually can turn it into a higher probability trade. Before I do that, let me just mention this. You know, this has been more sideways, and when you're coming up with the trade, you may have kind of a bias. Maybe it's kind of mostly neutral, but maybe you're a little bit more biased to one side or the other. So for example, on our CRM trade here, maybe we're looking at something like this and go, well, you know, yeah, it's been kind of more neutral lately, but the general longer term trend has been down. So therefore, I'm going to give this a little bit more of a bearish bias. How can we do that? Well, we can just adjust our strikes on this. So instead of, I'm going to just adjust this. So what I'm going to do is I'm going to make this an unbalanced butterfly, or what we call a kind of a broken wing butterfly. In other words, the distance between our strikes is not going to be the same. On the one side, I'm going to make it very tight. On the other side, I'm going to make it a little bit looser. What if we do this? 290? I don't know. We can tweak it however we want. Let me go down here. Now let me just set my slices to break even. And let's look at the characteristics of this trade. What are the odds now that we are break even or better? Well, there's only one break even point. It's right there. And basically 2/3, 1/3. Okay. Now, it's not the nice, neat, symmetrical pyramid shape that we had on the others. In fact, what you'll notice is if it goes down, it actually never goes below zero. It's profitable all the way down. Okay. Theoretically, it's profitable all the way down. Okay. Now, if it goes way down, am I making a lot of money? Well, not that much. I mean, here's my break even, here's my gain. So not much. Here's the stock right now. We want it to go down a little bit. Okay, we want it to go down a little bit. If it goes up against us, well, it can be not pretty. It gets worse, right? In fact, here the loss, our risk, the difference between our break even and our loss is bigger. We're going to call that risk. That is bigger than our potential gain on this. Okay, here's my max gain, which again is kind of trying to hit the edge of a knife right there, as I think someone said earlier. But so we've adjusted it. We've turned it to a higher probability trade, but our reward to risk ratio is not quite as well. All right, is not quite as good on that. Now, as I mentioned earlier, if you want more on butterfly spreads, more in depth on butterfly spreads, I put that link in the chat above there for you, where I do a full session on butterflies. But I want to get to trade management here on this. I'm gonna go here and just remember, as you're doing these trades and you are looking at them, you have different expiration dates on it. It doesn't, whether you're doing a butterfly or not, look at your liquidity on the trades. You can look at things like, to help with that, you can look at your open interest and see what's available there on you. And here's your open interest column. I would not focus as much on the volume column, focus on the open interest. Also look at the bid ask spread, the difference between the bid price and the ask price on these contracts there is something for you to look at on that. But you can choose your expiration dates. If I just go up here and click on Butterfly, and I go, what do we say? Our middle strike was 270, and I do that call Butterfly. I click on that. It's going to come up right here. I can then adjust those strikes to like what I had before, 290 or 285 or something like that. And that, in this case, it's actually turned it into an initial credit transaction instead of a debit transaction, which is typically going to be a Butterfly spread on there. So then you can confirm and send that trade. If you want to send that, I'll put that in this is a broken wing Butterfly. We'll put that in our Butterflies category, and we're going to send that order, and it filled right there. Okay. You can always tweak those strikes though. When you're looking at this on your Analyze tab or else, and you want to play around with it. Play around with those strikes and see what best fits what your forecast is. All right. So now I wanted to leave a lot of time here for managing trades. But in terms of managing this one, a lot of the principles that we teach in terms of managing trades are, on this one, we're starting with like, how many days to go? 21, 22, 23 days, something like that to go on this before expiration. Once we get with about a week to go till expiration, we'll probably look to get out of that, okay? If this goes down, which is what we want, or sideways, which is what we want, that's great. That's what we want. But if we break, say, the resistance level that we think is a resistance level, then we may look to exit. So on this trade, we may say, look, I think this is kind of going down. This is going south. I have let me draw my horizontal line here on this. We'll say this was kind of a support level, bounced there, bounced there, bounced off there. This is about 273. If we break above that significantly, we'll say up to 280, we're going to get out of that trade. And you can get out of that trade by simply going here to your trade, CRM. We can right click on this. We can create a closing order, and this is going to be the order to get us out. And we can just say, I'm going to make it a market order, good till canceled. And I forgot what price we said. We said about 280 we're going to get out. So I'm going to go, where was I? I'm going to click on my gear, and I'm going to put, if it marks greater than or equal to $280 on the underlying stock, we're going to look to exit that trade and confirm and send. And now we're going to send that. Okay, so now we have an exit order on that. Now, one more thing before I get out of this trade. 280, this is, 280 is about actually, how much are we losing at the 280? About $680, but that's way less than our potential loss, which is roughly at expiration $2,100. So we'd be losing about roughly a third of our max loss at that point, theoretically, because this is all these probabilities I've showed you, the gains, the losses, these are not guarantees on any individual price on that, okay? All right, now let's talk about managing some other positions here as well. Let's talk about short verticals. We started off the trade with short verticals day, talking about probabilities and short verticals. Remember your exits though. On most of these trades, what we're going to do is we're going to have a time exit, okay? We're going to have if it goes for us, if things are going well, exit. I'll just put a plus to symbolize that. If it goes against us, exit as well. And so we're going to consider each of those scenarios on this trade. So in this case, let's start with PayPal. What do we have here? What do we have here? Well, I've got a short put at 70. I've got a long put at 68. Same expiration date. That's a short put vertical. This is a bullish trade. Days till expiration, 22 days till expiration. Now, I had another comment in the survey that we sent out last week, I think it was, saying, how do I manage short verticals? Do we use delta to decide when to get out of short verticals? Typically, that's not how I teach it. The way I teach it is this. Get out if we get close to expiration. In other words, less than 10 days to expiration, we're just going to exit. Well, we're not less than 10 days to expiration, so I'm not going to get out for that purpose. Number two, if I've broken like a support level, okay, if it technically it's broken down on me, this was a bullish trade. Is PayPal now starting to look bearish? I'm going to get out for that reason. And I'd say no, it's actually continuing to be fairly bullish on that. Okay, so that's good. That's another reason. That'd be an exit in this case if things go against me. Have I made almost everything I can make on this trade? In other words, 80% say or more of this trade. Well, at expiration, the pricing, this is a $2 spread width on here. This could potentially, well, actually, hold on one second. I don't want to explain it that way. This can go down ideally to zero, okay? The pricing on this can go to zero. When we initiated this trade, this was about 50 cents, 49 cents, okay? So we brought in a $49 credit on this trade when we started. $49 credit on this trade when we started. How much, if we were to buy it back right now, I'm not going to factor in commissions, would it cost us? Well, it cost us approximately the difference between these two, which is about 21 cents or so. It's moving about 21 cents, okay? So start at 49, potentially it could go to zero. Have we made 80% of what we could make? No, 80% of what we can make would be about roughly 10 cents. Here, we still have enough meat on the bone, so to speak, on this for this to work out for us. Our time decay is positive on this trade. It's helping us out. So we have an exit if we're going to exit if our time is going till expiration, if we've made most of what we can make, we haven't yet. If things are turning south on us, we may look to get out. Those are all reasons we may get out. In this case, we're just going to let it sit here, okay? So I'm going to bypass that, and if you have any questions on that, let me know. Let's look at another one. Now, I have this in my short verticals iron condor camp, and we kind of consider these together, these type of trades together. Because once you have an iron condor and you look at it, you'll see, oh, that's a short put vertical. This is a short call vertical. Short put vertical, short call vertical. And often one side or the other is going to do well and the other side may not do so well. And what we can do is we can manage those independently of one another. Now, right now, we're doing okay overall on UNH. The stock is at about 307 right there. My short strikes are 330 and 275. So it's kind of in the middle of them. So this actually, both of these are doing pretty well individually. Often that isn't the case. Often one is doing pretty well and one's not doing very well. Time till expiration. We can still have 22 days on that. So we're going to let that sit in terms of time till expiration. Obviously, we're not losing money. We can take a look at the chart, UNH, and see, well, is it starting to look more bullish or bearish? Here's UNH. And no, I mean, this is kind of like ideal of what we want to see on that iron condor. It's just kind of going flat on this. let's also look at it from this perspective. So there's no reason to get out because of the technicals on that, it seems. There's not a reason to get out because of the days till expiration. Have we made almost everything we can make on this trade, on either of these? Well, we got into the trade, the short put vertical component of that, for about 95 cents. Do you see how I'm doing that? I'm just subtracting the prices of the two, okay? 95 cents is what we get. How much is it worth now? Oh, about 32 cents. Have I made 80% on that? No. What 80% be? Just to make 80% means the trick is you just multiply this by 0.2, for example, okay? 9.5 times 0.2 is about 19 cents. 19 cents. If this were worth 19 cents, this would be worth about, we would have made 80% of what we can make on this. But we're not there yet. It's worth 32. Okay. Let's do the same thing on this. We already looked at time. We already looked at if it was going against us. It wasn't. Our initial trade was it was about 75-cent credit when we got in, this portion of it. How much is left on this trade? Well, about 70 cents is left on this trade. So we haven't made much on this. How would we know if we got to the 80% mark? Again, I'm going to take 0.2, multiply it by 75, or just multiply 75 times 2. That's 150. Move the decimal point over. That'd be 15 cents. We're clearly a long ways away from 15 cents. We're going to let this cook, so to speak. Let this bake in the oven because, remember, these trades, our time decay is helping us out on these trades. So it going sideways, time decay is going to help us out on that. All right, so bottom line, we're going to stick with both of those short verticals. Now let's look at some different types of trades though, okay? Let's look at some long single options. So I have long single options. Here's XP. This one is actually going pretty well. This was entered as a trend trade. We have a sell. We have a stop on this at 165. 165. Let me take a look at this. We initially bought this for 213. Okay. Initially bought this for 213. Right now, it's 330. It's doing well. When am I going to get out of this? Well, we're going to get out of this when the trend doesn't trend up anymore. Well, let's look at XP here. Okay. Here's XP. Is it trending? Yeah, it's still trending up. No change there. So for that reason, there's probably not a reason to exit on that. Let's look at that stop though, okay? The stop is, I forgot where it was. Stop is at 165. Well, we can probably move this stop up. Here's how I'm going to consider this stop. The option is at 330. The delta is close to 75 on this. We can have a stop probably at 70% of this. If I take 70%, 0.7 times 3.3, I come up with about a 231 stop. I would consider moving my stop up to 231. Why did I come up with 70% on that stop? Here's why. Generally, the more in the money the option is, the less volatility there is in terms of percentage of the price movement. And therefore, I can keep my stop relatively tight. Now, a tight stop on a stock may be a stop that is 95% of the stock price. Typically, you can't do that in an option. Options are too volatile. So usually we're not going much above 70% on the stop there. If we have a contract that's at the money, they tend to swing around more, a little bit more volatile. If it's at the money, the stop may be closer to a 50% stop. Multiply it by 50%. But in this case, our delta is 73, 74. So I'm using that 0.7 calculation. So all I did was multiply the current price times 0.7. That gave me 231. And that's where I'm going to move that stop to. So I'm going to go to my sell button here. I'm just going to click on that. And here it is. You can see that right now. It's at 165. The point is, we want to try to help protect our gains in case that nice trend we saw on XP goes against us. It's not a guarantee. Stops do not guarantee the exit at whatever price we have. Cancel, replace order. I'm going to click on that. And this is just going to replace my existing order of my 165 stop with 230. My number lock's not on. 231. Okay. This is just going to overwrite that other stop. We're going to send that order, and we canceled the other stop. We now have a new stop in to try and help protect us if things go against us on that trade. Okay, let's look at some others. Let's look at Morgan Stanley. What do you think about Morgan Stanley? What about this trade here? This was let's see what it says. What do we put on here? Entry above 131. Okay, this was a trade that we initially put in, and we were waiting for it to go above a particular price before we got in, 131. When we initially got in, when we were initially there, it was just kind of sitting there. It had to jump up to get in. So we actually haven't been in that long, but it's going, how's it going? Nothing to write home about. We're up $10 on this trade. But we only have 9 days to go till expiration. Wiley hit it on the head. We only have 9 days to go. So do I need to get out right now? No. If I had strong upward momentum, you could continue to hold this trade. But this is a long call. What's our theta doing? We're losing money every day on this trade, okay? We're losing money on Morgan Stanley right now on this trade. So based on the time decay. Now, if the stock goes up enough, it will more than make up for that. So we don't have to get out, but with 9 days to go to expiration, you bet I'm going to get out of this trade. So I'm going to just cancel my stop orders on this. I'm going to cancel that, okay? And I'm going to look to exit this trade. We'll take the puny profit that we have at this point on this. We're going to create that closing order, and I'll go see if we can get a little bit better than that. I don't know if that's going to fill or not. 405.14. We'll see if that fills, okay? Yeah, it filled, okay? So we got in at a good price on that, I think. Okay. So there's our Morgan Stanley trade. I want to do one more long call, and then I want to go to a different type of trade. I want to go to Pfizer here. Here is Pfizer. What is this? What kind of trade is it? Well, it is a long put, but it's a special type of long put. Notice that. That's a leaps put. We covered this a little while ago. This is a leaps put, meaning we're long-term downtrend. And I'll tell you why we got in this trade. And right now, where are we on this? We're down $77. We're losing money on this trade. Darn it. Well, let's look at Pfizer here. Okay, let's see what went wrong. Well, this is what went wrong on this. We were looking at something like this. And we were saying, let me see if I can activate this. That's not how I drew the line, I don't think, originally. I think we were, come on. See if I can change that. I think we were looking at something kind of like this here. And we got in, and our assumption was, hey, look, Yeah, it's gone a little bit more sideways lately, but the general trend has been down. It will probably bounce off this area here. Well, you know what? We were wrong. We were wrong. And not only has it broken out a little bit, it is significantly broken out. It's broken out to a percentage-wise a pretty big number. It's also stayed above that for several days. And as Wiley pointed out, yeah, we're starting to get higher lows now on that. So you have to reassess, regardless of what my profit or loss is, regardless of how many days till expiration. On these trades, ask yourself, why did I get in? What was the purpose of this trade? The purpose of this trade was to get into a long-term downward trend and to take advantage of that. Right now, my idea of that has been destroyed from the technical analysis. Now, there's other ways to look at it. You could do a fundamental analysis and maybe you're bearish on Pfizer, in which case maybe you consider holding with it. But using a technical approach, I'm not going to stay with this trade. Unfortunately, I don't like losing the $75 there, but I think it potentially may save us from bigger losses along the way. So I'm going to just take the smaller loss on this because potentially this could be a big loss if this keeps going up. So I'm going to close this order and I'm going to get out of this trade. Natural price 410, mid price 415. I'm going to get out, so I'm just going to leave that at that natural price, more likely to get filled at that natural price. We're going to click on that. We got filled on that. And I accidentally clicked on something, what did I click on? Oh, I clicked on active trader. Okay, we want that. Okay, let's keep on going here. Let's go to, we talked about long calls, long puts here. Let's keep on looking at some others. Calendars. Notice this one. This is one we just entered. This is calendars, butterflies. I kind of them all grouped together. That's what we just entered. Coke, we're in. Only 2 days to go till expiration. Okay? Only 2 days to go to expiration. So we're just going to get out. Anytime we're 2 days to expiration, I'm going to look to get out. I'm going to click on this. I'm going to cancel. Regardless of where my stop is, regardless of my target, I'm just going to look to get out of that trade. I'm going to right click on this. See, does it give us? No. Let me highlight all these. Right click. We're going to create this closing order and we're going to look just to get out of that. There's my mid price, confirm and send. I'll go in between my mid and my natural price on that. Okay. Do you guys understand that, by the way, in terms of natural and mid? The natural price for a long option is going to be the ask price. Okay. That means you're going to be paying for a long option is the natural price. That means you're going to be paying more for that. That is not what if we're buying, if we're buying an option, buying a single option, it's going to be the ask price. If I'm selling that option, the natural price is going to be the bid price, which means we're selling for less. We'll probably get filled, but we don't want to pay the higher amount, or we don't want to sell it for the lower amount. Preferably, we'd get in at a different price. Preferably, we'd get in at the mid price, which is in between the mid bid and the ask price. That means we'd be buying for a lesser amount. You want to buy for a cheaper amount. You'd be selling for a little bit more amount. So why don't we always just enter it at the mid price? Because you're less likely to get filled on that. So if I'm very urgent to get out, I'm more likely just to accept the natural price. Probably on more trades, though, I'll go not at the mid price because it seems probably unlikely to get filled, not at the natural price, but a price in between those two. That's what that is. Okay, now I'm just about out of time. Yeah, we're out of time. Okay, where can we see the managing options session playlist? It goes back to what I mentioned before, folks. Let me just show you this one more time here. If you go to the Trader Talk Schwab channel, go to Trader Talk Schwab Coaching Webcast, just click on playlists. The managing, and it's going to be on here. And I don't know exactly where it is. You may just have to look through it. Managing options portfolio right here. That's how you can see that playlist right there. Okay. So we talked about a variety of trades today. We talked about probabilities. Higher probability trades, lower probability trades. We talked about how butterflies are often lower probability trades, but if you make it a broken wing butterfly, you can actually kind of tweak that and make it a higher probability trade and also skew it a little bit to be more bullish or more bearish. We talked about managing short verticals, including those that are part of an iron condor. We talked about managing long single options, and we talked about the double calendar, which was just about expiry and getting out there. Coming up next, we've got trading price patterns. Okay, Barb Armstrong teaches that class. Make sure you check that out. Appreciate you guys. Always love having you here, and I'll stay tuned or check out that trading price patterns class. And thanks, Ben, for helping me on the chat today. All right, everybody. We'll talk to you later. Bye-bye.